Good morning. So, assuming that most people that are watching this, most people that visit Trader's Base are from the good old safe haven of the United States, I'm going to show you something that you might not know today. While the United States has been relatively sideways since April, maybe down slightly, emerging markets have been getting clobbered. So right now I'm looking at EEM, the emerging index fund from iShares, and we see that it actually topped off in March at about 44 bucks, and now it's sitting around 37.58. So more than I think that'd be a 15% decline. Okay, but what am I seeing right now? It really looks like, especially if I go into a weekly chart, actually I want to zoom out here to see. Okay, well there's something first about, okay, I'll talk about what I was doing first. On the weekly right here, you see that we have a pretty much vertical move down and then a move up. And we also see that the move up, starting right here, was also on declining volume. So what's that usually indicative of? It means that this is likely a weekly flag formation. So the weekly flag formation is it's a continuation pattern, and it basically says that after a vertical price move and a small consolidation, you expect the price to break through and continue to move down. So even though it's upside down, you might be able to see somewhat of a flag right there. So what's the actual price target for this? Well, the actual breakout point would put us at about, I would say, I'm actually going to have to move into the daily chart to take a look at this. Resize this a bit so I can see it. And the breakout actually happened yesterday, and it also happened on fairly high volume. But the actual target would be the height of the pattern, which is from the breakthrough this support level at about $41 to the bottom of the pattern around 36. Project that from the breakout point, and it gives us a target of just around 32.50. So target is 32.50, and we can actually go out and short this right now if we wanted to. So let's see where this is opening this morning. 37.54, sure, why not? So you can short at 37.54. Probability of success conservatively from the Bolkowski studies is about 50%. So 50% chance it's going to hit this target. But the thing that I really wanted to talk about was the pattern forming in the long term, which this right here, it almost looks like a head and shoulders pattern. So let's actually move this one into a 1-year chart and resize it one more time. It almost looks like a head and shoulders pattern with a slightly upsloping neckline. Now, I need to consider the volume characteristics to actually make a judgment to see whether or not this is a head and shoulders pattern. So let's actually take a look at this. So on the first shoulder, we have, so right here, we have very high volume. Okay, that's great. Second shoulder, we have less volume. And then the third right here, you notice how as price is going up, we have this nearly concave shape until price starts moving down again. So that's that's a good indicator of a strong head and shoulders pattern. So this actually gives us, and this might make you sick, but this actually gives us a price target that says that we might be headed toward another 2008. So price target will be top to bottom of the chart, projected to the downside. Okay, not 2008 yet. Maybe on the super long term you can see that. But target for that pattern, and that pattern would be confirmed if it breaks below 36 bucks. Yeah, 36 bucks. That target's going to be about 27.50. Now let's take a look on the very long term. Once again, another head and shoulders pattern with, once again, high volume on the first shoulder, lower volume on the second, and also low volume on the third. This one is going to have a neckline sitting at about $33. So if the $33 line, actually I'm going to take it to the extreme low, so $32.50. So if $32.50 breaks, that's going to give us a price target on EEM, and then we have another 2008 right here. So price target is 17 bucks. So there's a bunch of different trades that you can take advantage getting short on this. Let's actually take a look to see if we have any opportunities with options. See if they're underpriced, overpriced, or whatnot. And at this point, we're looking right now at the relatively cheap, not necessarily super cheap like they were back in last April, but as far as 2012, they haven't been cheaper than they are right now. So what you could do with this is, I would probably, assuming that the puts don't have a huge spread on them, let's see. First off, it's easy to borrow, so that means if you just want to short it, feel free to, but I would probably suggest playing a leap put on this, so a long time frame. So I'm looking at the January 14 puts, and here's what I'm getting. If I can do, okay, the spread is perfectly fine. So the 35 put, if we would say buy this, and what's the implied volatility? 32.98, that's fine. So we buy this, and by January 14 we expect this to get down to, like I said, around 16 bucks. Risk profile, we move this chart over, we actually rescale the axis, and if it gets down to 16 by that point, we see ourselves making about 1,500 bucks. And our actual risk, since this is a long distance option, the whole time factor is not going to be too important, but it's still going to be as if we are shorting shares. So what we can do, we can short immediately, and we can place a stop level if, let's say if we get above, let me just do a quick retracement bracket. If we get above 39 bucks. So if we do a 39 buck stop, that gives us a max risk of about $60, max gain of about 1,500. That's fantastic. All right, happy trading.